Financial Management Solution Chapter 1 Role of Financial Management 13th Edition Van Horne Chapter 1 Role of Financial Management answers two questions. Q1. If all companies had an objective of maximizing shareholder wealth, would people overall tend to be better or worse off? Answer. Capital will tend to be allocated to the most productive investment opportunities risk-adjusted return basis. Other decisions will also be made to maximize efficiency. If all firms do this, productivity will be heightened and the economy will realize higher real growth. With reslicing, it is possible some people will be worse off, but that is the result of a governmental change in redistribution. It is not due to the objective function of corporations. Q2 contrast the objective of maximizing earnings with that of maximizing wealth. Answer. Maximizing earnings is a non-functional objective for the following reasons. A. Earnings is a time vector unless one time vector or earnings clearly dominates all other time vectors. It is impossible to select the vector that will maximize earnings. B. Each time vector of earning possesses a risk characteristic. Maximizing expected earnings ignores the risk parameter. C. Earnings can be increased by selling stock and buying treasury bills. Earnings will continue to increase since stock does not require out-of-pocket costs. D. The impact of dividend policies is ignored. If all earnings are retained, future earnings are increased. However, stock prices may decrease as a result of adverse reaction to the absence of dividends. Maximizing wealth takes into account earnings, the timing and risk of these earnings, and the dividend policy of the firm. Q3. What is financial management all about? Answer. Financial management is concerned with the acquisition, financing, and management of assets with some overall goal in mind. Thus, the function of financial management can be broken down into three major decision areas. Management decisions. Q4 is the goal of zero profits for some finite period 3 to 5 years. For example, ever consistent with the maximization of wealth objective? Answer. Yes. Zero accounting profit while the firm establishes market position is consistent with the maximization of wealth objective. Other investments where short-run profits are sacrificed for the long run also are possible. Q5. Explain why judging the efficiency of any financial decision requires the existence of a goal. Answer. The goal of the firm gives the financial manager an objective function to maximize. He/she can judge the value efficiency or any financial decision by its impact on that goal. Without such a goal, the manager would be at sea in that he/she would have no objective criterion to guide his/her actions. Q6. What are the three major functions of the financial manager? How are they related? Answer. The financial manager is involved in the acquisition, financing, and management of assets. These three functional areas are all interrelated. For example, a decision to acquire an asset necessitates the financing and management of that asset, whereas financing and management costs affect the decision to invest. Q7. Should the managers of a company own sizable amounts of common stock in the company? What are the pros and cons? Answer. If managers have sizable stock positions in the company, they will have a greater understanding for the valuation of the company. Moreover, they may have a greater incentive to maximize shareholder wealth than they would in the absence of stock holdings. However, to the extent persons have not only human capital but also most of their financial capital tied up in the company, they may be more risk averse than is desirable. If the company deteriorates because a risky decision proves bad, they stand to lose not only their jobs but have a drop in the value of their assets. Excessive risk aversion can work to the detriment of maximizing shareholder wealth, as can excessive risk seeking if the manager is particularly risk prone. Q8. During the last few decades, a number of environmental, higher-end, and other regulations have been imposed on businesses. In view of these regulatory changes, is maximization of shareholder wealth any longer a realistic objective? Answer. Regulations imposed by the government constitute constraints against which shareholder wealth can still be maximized. It is important that wealth maximization remain the principal goal of firms if economic efficiency is to be achieved in society and people are to have increasing real standards of living. The benefits of regulations to society must be evaluated relative to the costs imposed on economic efficiency, where benefits are small relative to the costs. Businesses need to make this known through the political process so that the regulations can be modified. Presently, there is considerable attention being given in Washington to deregulation. Some things have been done to make regulations less onerous and to allow competitive markets to work. Q9 as an investor. Do you think that some managers are paid too much? Do their rewards come at your expense? Answer. As in other things, there is a competitive market for good managers. A company must pay them their opportunity cost. And indeed, this is in the interest of stockholders. To the extent managers are paid in excess of their economic contribution, the returns available to investors will be less. However, stockholders can sell their stock and invest elsewhere. Therefore, there one is a balancing factor that works in the direction of equilibrating managers' pay across business firms for a given level of economic contribution. Q10 How does the notion of risk and reward govern the behavior of financial managers? Answer. In competitive and efficient markets, greater rewards can be obtained only with greater risk. The financial manager is constantly involved in decisions involving a trade off between the two for the company. 1T1 is important that it do well what it knows best. There is little reason to believe that if it gets into new area in which it has no expertise that the rewards will be commensurate with the risk that is involved. The risk-reward trade-off will become increasingly apparent to the student as this book unfolds. Q11 What is corporate governance? What role does a corporation's board of directors play in corporate governance? Answer. Corporate governance refers to the system by which corporations are managed and controlled. It encompasses the relationships among a company's shareholders, board of directors, and senior management. These relationships provide the framework within which corporate objectives are set and performance is monitored. The board of directors sets company-wide policy and advises the CEO and other senior executives who manage the company day-to-day activities. Boards review and approve strategy, significant and investment acquisitions. The board also oversees operating plans and capital budgets and companies' financial reports to common shareholders. Q12 Compare and contrast the roles that a firm's treasurer and controller have in the operation of the firm. Answer. The controller responsibilities are primarily accounting in cost accounting as well as budgets and forecasts would be for internal consumption. External financial reporting would be provided to the IRS, the SEC, and the stockholders. The treasurer's responsibilities fall into the decision areas most commonly associated with financial management: investment, capital budgeting, pension management, financing, commercial banking and investment banking relationships, investor relations, dividend disbursement as asset management, cash management, credit management. The end. If you like this video, then don't forget to share and subscribe. Thank you.